guys, and welcome to today's content. We're going to be talking about weak and strong points. Initially, weak and strong points is exactly the same as the structure video. Nothing has changed except the terminology. Initially, we use this terminology because of the analogy behind weak and strong points. It adds on to the understanding. So, sort of moving on here. Initially, the analogy behind strong and weak points are pretty elementary. In essence, a weak point will get taken out most of the times because of how a trend is structured. Strong levels will most likely be protected most of the times because, again, of how a trend is structured. So just sort of talking here on a few key points. The smart money concept, structure, method, weak and strong points. This is sort of just, again, what I sort of mentioned in the previous videos. This is more of the smart money way on how we sort of, how can I say, how we name structure. Yeah, so initially weak and strong points are no different from higher highs, lower lows, lower highs, higher lows. They're named differently because of the logic behind the weak and strong points. And initially, another key thing to take away is weak levels will fail most of the time. If a strong level fails, we change direction. So let's sort of touch on here again. We're going to touch on the bearish side of things, we're going to touch on the bullish side of things, and we're just going to talk again on the application. So moving on here. Initially, bearish trend contains several bearish structures. Bearish structures are formed in a series of strong highs and weak lows. So we can see sort of like the SH, the acronyms, SH, WL, weak low, strong high. On the bullish side of things, we have WH, weak high. We have SL, which is a strong low. So moving on here, we're sort of going to touch on this again. We can see we have a weak low, strong high, weak low, strong high, weak low, strong high. Now again, from a bearish perspective and a retail terminology, we would say lower low, lower high, lower low, lower high, lower low, lower high. On the flip side, from the bullish side of things, higher high, higher low, higher high, higher low, higher high, higher low. So again, it's pretty standard stuff. It isn't something that's needed for overcomplicating. If you understood the structure video, this video should be a walk in the park for you. Just sort of touching again on a few key things from the structure video that we're sort of going to be replacing into this video. Initially, strong high can only be formed when we take out a weak low. So again, for a strong high to be formed, we need to see this weak low get taken. We can see here we create a new weak low, we create a new strong high. This strong high is only confirmed as soon as we take out this weak low, and so we sort of continue on the bearish side of things. Going on to the bullish side of things, strong low can only be formed when we take out a weak high. So when this weak high gets ran, then we sort of can confirm that this strong low is confirmed. Again, on this weak high, we can now confirm sort of that this strong low is confirmed as soon as we run this weak high, and so we continue onwards. Initially, touching again on the bearish side of things, if a strong high gets taken out, then our expectation goes from bullish to bearish. So if I'm just taking my brush tool here, if we take out this strong high, our expectation goes from bearish to bullish. We now expect strong lows to be made and weak highs. So we then expect bullish trends. Continuing onwards on the flip side from the bullish structure, same thing here. If a strong low gets taken out, then our expectation goes from bullish to bearish. So if we saw a follow through from this level and we take out this strong low, we can sort of start to expect a bearish trend initially, creating weak lows and strong highs. So again, that's just pretty standard procedure for us. It's just basically replacing the terminology. The analogy, again, basically the analogy is what sort of makes it a little bit different. The analogy eases on to the concept itself, and you're going to sort of understand at a much later stage why we sort of chose weak and strong points, and why we sort of use them to add on to the analogy and so on. So just a few key tips as well to sort of take away from this. I would definitely sort of recommend you writing this down. Always trade away from strong points and trade towards weak points. On a later stage, we will touch on how we use strong points to look for points of interest and how we use weak points as targets. So initially, you always want to be looking for trades at strong points. You want to look to trade away from them, and you want to look to target weak points. So again, weak lows, weak highs, you want to use them as targets. Strong points, you want to use them as areas for potential points of interest. So touching on the application, this is the application of structure. It doesn't change. We still want to see that candle body close, so that doesn't change. We can sort of move on from there. And touching sort of again here on the examples we used. If I just remove this to my left, because I don't know why this is here. But touching on the examples that we sort of used in the structure video, we can sort of see here again, we have these breaks of structure that indicates all these lower lows and lower highs. Again, sort of from the bullish side of things, we have these breaks of structures which represents higher highs, higher lows, and so on. So I'm just going to sort of touch on how strong highs and weak lows fit into all of this. So initially we form a strong high here after we've taken out this weak low. This high is strong because it takes out this weak low. You can see we have a follow through. We then create a weak low. The strong high is only confirmed the moment this weak low gets ran. The moment we run this weak low, this strong high is confirmed. Again, it's a strong high, it's a protected high. We're not expecting price to run this high. So again, that's why we sort of say, you're looking to trade away from these levels, because it is strong levels. You're not looking to trade into these levels specifically. So yeah, moving onwards, we can sort of see how we continue on with the trend here. Weak lows, strong high, weak low, strong high, weak low, strong high, weak low, strong high. So again, it's pretty standard stuff. Initially, a strong high can only be formed as soon as we take out a weak low. So initially, weak low for targets, strong highs for entry points. So we can sort of understand at a much later stage how we are going to utilize strong highs properly and weak lows properly. So continuing onwards here, touching on sort of from that bullish to bearish or bearish to bullish expectation, where we sort of talk about where the trend starts to shift. We sort of touched on this. If a strong high gets taken out, then our expectation goes from bullish to bearish, well, bearish to bullish. So we initially take out this strong high, and initially we now create a new weak high. So after we've created this weak high, we now create a strong low. This strong low is only confirmed the moment we take out this weak high, and initially we just continue our way to the upside. We can see we have a weak high, we have a strong low that can only be confirmed the moment we take out the weak high. Again, touching on the fact we wanna trade away from strong lows, and we want to target weak highs. As you can sort of just see in the examples, weak highs, they get ran because they sort of fall in line with structure. We can see we're pretty successful all around, and all these weak highs get ran. Same with these weak lows, they constantly are getting ran by markets. So initially that's why we use them as target points, and we use again strong highs and strong lows, strong points as point of interest, because we can sort of see when price starts to trade from these levels, we can start to see market push into our direction. So initially, again, touching just here quickly on the flip side of things, from going bullish to bearish, we can see we take out this strong low, which again sort of indicates to us we are going bullish, from bullish to bearish. So initially, that's just basically it for this video. It's not an overwhelming concept. It's basically exactly the same as structure. It's just we use this because the analogy is a bit different. and it's easier to explain and give over to the students. And yeah, that's just basically about it. Should you have any confusion here, just feel free to ask questions into the Discord. Me or one of the coaches and the team members will be happy to sort of help you or offer you a one-on-one to sort of explain this to you, and that you can grasp the understanding around this. So thank you guys for tuning in. I'll catch you on the next one.